right there, everybody. Thanks a lot for joining me on this Wednesday afternoon market recap. I have been a little bit quiet as at the close on Monday and Tuesday, really through to that of the close on Tuesday. The markets themselves were still relatively unchanged. I have been waiting for the markets to produce that of a more of a material signal to talk about before I come on the airwaves and give you this, as it stands anyway, Wednesday afternoon market recap, just to show you obviously how the first quarter of 2020 ended when it comes to the S&P 500. As you can see up here in the top left-hand corner of my screen, this is Monday's candlestick here, and this is the final trading session as at the month or for the month of March 2020, really contained obviously between that of Friday and also Thursday's session of last week. You can see really the markets themselves, Monday through Tuesday, they really went nowhere, really contained within the last sort of two sessions of the week just before us. Now, as we fast forward and also at this particular point rewind into that of Wednesday's session, you can see that on the S&P 500, we did close down 114 points. What makes this move even more interesting is that we have produced another gap. This gap is in the bearish direction. And again, a lot of people are looking at the back test of this trend line. This analysis itself right now is going to be very valuable for you, I hope, because I don't want you to fall into the incorrect camp of people actually breaking down this price action. What's really going on here at the moment is that the markets are still enduring that of its lingering first wave of the hangover, like the actual sell-off. This is really produced and really best illustrated through that of the weekly oscillators. Obviously on the daily time frame, which is what I'm about to show you, or at least in due course, you are going to see that on the daily time frame, these have now shifted and they have turned up. But again, you still have that overarching fractal, that being the weekly that we are still contending with. And again, that still hasn't positively or at least changed to the upside. So until that actually happens, you're going to see again that lingering sort of sell side momentum and also sell side volume really contain price action below that of this primary bullish trend line that has been in effect since 2009. We spoke about this over the weekend, and it makes a lot of sense as to what is happening at this particular time. It's very important to point out that on the 23rd, which was Monday's candlestick going back a couple of weeks ago now, and that of the obviously the opening and full body price on Tuesday, that we have, right, opened up a bullish reversal window down here. So again, it's natural to see the markets to actually continue up on their bullish ways up until the back test of this trend line and then to see it roll over. It's my expectation that over the coming sessions, if not the coming weeks at the markets, and this is not only confined to the S&P 500, it is also confined to the Dow and to the NASDAQ, is that we are going to ultimately come back down to these areas. We are going to close these open windows, and it's my assumption at this particular point that we're actually going to take out Monday's candlestick low, which is priced in, or at least that date again was Monday the 23rd, right? So we're still looking at price action again, coming down to number one, definitively close this open window, and number two, eventually trap a lot of overly, aggressive short sellers below the swing low of this Monday candlestick. You can see this from a mile away if you remain objective in the analysis. A lot of people at this particular point are really calling for the back test and now this to be that of the failure. And they're looking at this on the daily time frame. But historically speaking, this is just purely incorrect. There's no other way of putting it. This is not what you call a substantive sort of retest of the primary bullish trend line. It doesn't happen as quickly as this. It's very uncommon. If anything, it just simply doesn't happen like this historically, whereby you see the break of the primary bullish trend line, you see the bounce, and you come on up and retest that bounce a couple of sessions later. You tag around it for a total of 4 sessions, and then you see the market roll over. Yes, I agree that the market is going lower. This is on an intermediate time frame. Very important that you understand the intermediate time frame. This is really the weekly oscillator view of just how oversold, or at least the continuation into oversold levels that we're currently approaching. But as we move on down, again, to close this window and briefly take out this support low, the market itself, it should stabilize, and that's going to truly be that intermediate bottom for the market. A lot of people are calling for this. I mean, first of all, I want to just extend an olive branch here and say that, look, over the next probably 12 to 18 months, this market, it is going substantially lower. However, it's not going substantially lower over the next 1 to 2 months. Yes, we can take out the swing low, and yes, I can see the market dropping a further 5% or so down to roughly that 40% retracement or correction level from the peak up here in February. But once that establishes itself, and once we move and see the weekly oscillators turn out of oversold, what's most likely going to happen is we are going to move into a period over, say, 4, 5, 6 months, maybe even at an absolute most into the end of this financial year, or this calendar year, I should say, into the US presidential election. What you should see is a wave of optimism come back into the market for an extended period of time. That is going to be the false wave. So right now, if you're thinking about this, number one, if you're thinking about getting net short long term, I think you're going to be able to find that at higher prices, okay, much higher prices to where we're currently trading at 2,470. There is going to be, again, some short-term pain in the market. However, that pain itself is going to be short-term. It's most likely going to trap a lot of traders down here, whereby on a weekly time frame, we're probably going to set up that of a hammer type of candlestick, and that lower wick itself is going to come in below the swing low of Monday's candlestick, again, dating back to the 23rd. And at this particular point, right, a lot of shorts are going to get caught, so to speak, with their hand in the cookie jar. And as such, that's going to set off, right, that multi-month. It's going to be ugly, but it is going to be a grind whereby price action of not only the S&P 500, but also the Dow, the NASDAQ itself, the Russell 2000, the Dow Jones Transportation Average, is going to move into a multi-month advance. That advance is going to take out this little swing high over here on a daily time frame that a lot of people at this particular point are incorrectly calling the back test of this primary bullish trend line. That is incorrect. If there's anything that you can take away from this Wednesday afternoon market recap, is that analysis right here, if anyone is calling that, as I've just explained, they're incorrect. They don't understand the fractals of the market. Yes, I mean, what we need to do obviously is weigh up the different fractals and understand where price action is moving. That's what we're trying to do here. And that's what we will continue to do, as I have done really publicly since 2012. So again, there is going to be another wave, so to speak, of fear and panic. It's going to be short-lived. It is going to take out the Monday swing low. And again, this may set up over the coming weeks. All right, we'll see how quickly this this decline actually continues. Yes, we do have, obviously, a reversal gap in the opposite direction. Maybe we fill that as at trading session on Thursday. But overall, and if I show you this on the weekly oscillators, you can see here that we still have a little bit further to go in the Stokes setting. More importantly, however, is that the MACD itself, although it is slowing in that net negative momentum, it still hasn't definitively, right, pushed back towards the neutral point. And when that happens, and if we can get up into the neutral point, you'll see this fast line actually come and very much so approach that of the slow line as well. We may see a little bit of acceleration into positive territory. Again, this is not going to happen overnight. And what this candlestick is going to look like, this is on a weekly time frame, but again, even if I zoom out into a larger fractal in a couple of weeks' time on a monthly time frame, you're going to see a candlestick that either closes down around the lows of the previous week's or month's candle, okay? But ultimately what you're going to see is that long lower wick, which will then give you that definitive intermediate bottom on the market. Now, if you fast forward this, say 6 months into the future, depending on how fast and how high this bounce does come on a weekly time frame when it does set up, right, you're going to have to be looking at a bunch of overhead resistance, right? We've got a confluence of overhead resistance, which is going to sort of somewhat coincide with the back test of this primary trend line. However, it's going to back test that trend line at higher prices. At the moment, you can see on the S&P 500, it's sitting in here just below, or really around, say, 2,625 points. In the future, obviously depending on, all right, the time frame of that and where it comes back into the back test, we could see this back test. I'm trying to move my screen over, but we could see this back test, depending on how deep it is, say up towards 3,000 points in a number of months' time. Okay, so this is not the back test of that trend line. They're sort of in the right vicinity of analysis. However, they're getting their timings wrong. Okay, we're still lingering, obviously, with the effects of this first wave of the sell-off. If I can push the number 4 key, and this is the daily time frame that I'm talking about. You've seen this very quick bounce, all right, off from this reversal candlestick down here on the 23rd. But on the weekly time frame, again, the Stokes are still turning down. The MACD is starting to plateau down in that very negative, right, net momentum area. And at the same time, on the RSI itself, yes, it is into oversold territory. It's only just starting to correct. So until these two fractals on the daily time frame and the weekly time frame really confirm one another, we aren't moving into that process of that multi-month sort of dead cat bounce, so to speak, whereby, again, you're going to see prices of the markets take out what they have priced in, right, towards the back end of March over here, okay? And that's going to obviously bring in a lot of new buyers into the market, expecting or at least anticipating that the worst is now behind them. That is not going to be the case. This market is going to move on up, at least on the S&P 500, a couple more 100 points above this. I assume it's going to be somewhere between 2,900 and 3,000 points. Okay, because that's really where the confluence is, and really that right shoulder too, if you think about that whole chart pattern, so to speak, of a macro reversal on a monthly time frame. But now is not the time, number one, to really be buying long whatsoever. And if you are considering buying long, you are going to get it at lower prices over the coming weeks. Also, if you wanted to lock in long-term short positions, put positions, again, I do think, and believe that you are going to be able to do such a trade, and again, push that expiration out, say 12 months into the future, again at higher prices. So right now there's a bit of a battle going on. There has been a battle for a number of weeks now. You can see that we're starting to build the structures. You can see the resistance structure. You can also see the support structure. Just to make this very clear, I expect that support structure to be taken out temporarily. It's going to trap, again, a lot of overly aggressive shorts. And at that particular point, that's going to mark the intermediate retracement, whereby historically speaking, we'll be looking at this market once it produces that intermediate low, right? Somewhere in the vicinity or range of, say, 50 to 70% bounce of this first wave of this sell side directional movement. And that's really going to set the countdown and the timer for where we're really going to move into some very longer term, right, bearish contracts if you're looking through at least trading the market through the use of derivatives. You can also do it, obviously, you can time it, so to speak, with individual stock trades as well. Or if you want to open, I mean, I'm not going to go into the detail here, but if you wanted to sell to open, so to speak, instead of taking, say, the put side contracts of options themselves, depending on the trading vehicle that you want to use. But right now, I just wanted to make it very clear that we are in the midst of a chop. This chop is going to continue, right, indefinitely. Really, I can see this sort of playing out all the way through May, essentially, whereby it is going to look a lot more dire at some particular point in the immediate horizon. However, it will be temporary. And as such, from that base, we are going to set up, right, a multi-month advance, which is going to be, again, an illegitimate sort of counter trend move, if that real trend is now to the downside, firmly speaking. I hope that makes sense. I can show you this on the Dow Jones Industrial Average as well. You can see the back test taking place. A lot of people are calling this the big macro back test of the primary bullish trend line. Incorrect. Okay, you've got the gap in the bearish direction. This is after, again, that same reversal that took place on the 23rd going into the 24th. We've got this open window. Expect the open window to be closed and also taken out. But that is going to be the real handbrake, the real true intermediate bottom. Once the true dip buyers show back up in, all right, probably the institutions to hold this market just below the lows of that Monday candlestick, whereby, again, you're going to enter into a multi-month short squeeze. It's not going to be as aggressive as what we saw towards the back end of March. But again, it's going to lull, right, or draw in a lot of people who are relatively what would you say, maybe have a short attention span, or expect that this for some reason is only going to last, say, a number of, say, 4 months until the markets reclaim their all-time highs. It's simply not going to happen. And on that bounce, more and more people are simply going to buy into, right, the public participation of the market drawing higher, until a point at which we come back on up and retest, of course, those confluences of resistance that are very clearly marked on some of my markets. And that is going to take place in 2020 at a later date. And at that particular point whereby, again, the actual sentiment out there is most bullish, expecting that the market is going to continue above roughly these vicinities that I'm drawing on my screen, and that they're just sort of counting down the time until the markets reclaim those all-time highs. That's really where that sort of prolonged downturn is going to actually stem from. Okay, so this has been a very quick first sell-off. Okay, a lot of people have been rattled by this. They've been shocked by it. Now we're getting, again, the abrupt back and forth chop, the whipsaw city, which again is not really conducive for swing trades. There is going to come a point where people absolutely lose it when Monday's low gets taken out on the 23rd, but that's going to set in stone a multi-month rally, which will then produce the first significant higher low, upon which most people won't understand this. They'll still be buying into it, whereby this is going to be the position, again, to enact some long-term bearish positions on the US financial market indices, also global financial market indices, as well as the markets price in their first substantive, right, lower high on a macro time frame, and also a lower low, which will then sort of set in stone the structure upon which moving forward will then take out, right, obviously, moving into 2020 and obviously into 2021 as well. I can show you this on the NASDAQ. You can see this simple relationship as well. It looks as though we're still holding up roughly above it. We're pretty much closing more or less on it. You can still see, obviously, this open window, the reversal gap that happened very quickly. Expect the lows to be taken out, but over a number of months to see this market rise higher prior to pricing in a legitimate, right, macro lower high. I can show you this on the oscillators of the monthly time frame as well. This is the NASDAQ. I'm actually going to take off my annotations on my screen at the moment so you can see this. Right, at the moment, it doesn't really look all that sort of severe. However, what we do have, and I made this point very clear in the weekend class just gone, is that we have multi-year divergence, which is very rare in technical analysis, outside of the fact that we are transitioning and moving into that of a macro, right, top on the global financial market indices. Have a look at this for yourself, the monthly time frame, especially the MACD. You You can see it here on the RSI. It started really at the very beginning or late 2017, early 2018, whereby price action, still building a series of higher highs. But now, based on this first sell-off, and again, this incoming bounce, it's really looking to me that we are pricing in that of a head and shoulders top, which again is pushing us out, if this is going to be a definitional textbook sort of pattern, somewhere towards, obviously, the presidential election in 2020. That's our thesis that we're working with moving forward. And that's why, again, at the previous video, I'm telling people that just be very concerned about what's simply going on. Obviously, headlines are going to be somewhat distracting, and you are going to see price action on a daily time frame move back and forth, depending on, of course, good and bad news. But overall, on a multi-year fractal, what we have now priced in is definitive divergence. That divergence on a monthly time frame is only just getting moving, which is a little bit scary, but it's not going to go down in a linear line. It takes a bit of time. And obviously, with these sell-offs, there are going to come, and this, you have to get this correct now and get this true and solid in your own mind. These bounces that we're talking about, these are going to be, right, in the opposite direction to the prevailing trend. The actual bullish bounces are going to be counter-directional bounces. So they're not going to be bounces in the direction of the prevailing trend. These are going to be now counter-trend bounces, which are going to set up and produce a significant lower high relative to where we were in the period of February. You can see this on the monthly time frame as clear as day. You can see it on the MACD. You can see it again on the RSI. Not as clear, so to speak, on the stochastics, but really when you're talking about D for divergences, you're talking about the MACD. The MACD is critical, and very rarely, again, do you ever see divergence on a multi-year basis on a monthly sort of chart itself, unless, of course, you're moving into a macro primary reversal. Oftentimes, you'll see it very clearly on the weekly, but when you see it on a monthly time frame, to me, that's even more indication and an even larger warning that we are in the midst of something very, very serious at this particular juncture, okay? So short-term pain, market moving below Monday's swing low on the 23rd, that will pull the handbrake. It's going to trap a lot of, again, overly aggressive shorts, and then people are going to be amazed as to why this market is moving higher. That bounce, however, is going to be counter-trend, and it is going to produce a lower high. A lot of people are going to buy into the bounce. Okay, you probably got, maybe even if you think about it, if you step back for a moment, you think about this, say on the S&P 500, maybe you were thinking to yourself that this bullish sort of bottom here was producing that of V bottom. And maybe you were even, to some extent, getting swept up, right, in this relief rally. This is still not a clearing rally. This is sort of more of a minor level bounce. When you're talking about a clearing rally, right, a counter trend clearing rally, you're really talking about it on a weekly time frame. So that's why I'm showing you that on the oscillators, until we see the weekly, especially on the MACD, definitively turn up and work in synchronization with the daily time frame, which again is going down a fractal, you're not going to see that legitimate long-lasting bounce, even if that sort of long-lasting term that I used is really for a period, probably no longer than 6 months. So you're going to time the weekly oscillators turning up, but instead of actually using them as a timer for the upswing, it's going to give you a really clear indication of what to look for, or at least the potential of that exhaustion up at the higher prices once that MACD begins to plateau, and that's going to be essentially what they call in technical analysis the kiss of death. So again, I've not necessarily really recapped Monday through Wednesday outside of really Monday and Tuesday were non-event candlesticks. Obviously today we saw it was a bit of a moving day on the markets themselves to the downside, but think about it in terms of the window being closed, right? The psychology of overshooting the lows, a lot of people panic selling at the worst possible time, seeing a base come back in, and then beginning on this journey, which over time more and more people unfortunately are going to buy into, assuming that the worst is now behind them. There are serious sort of structural imbalances and consequences to what we're seeing happening not only in the United States but around the world, and this is just really forming that of the textbook, right, definitional case of human behavior, and entirely the whole premise of what technical analysis itself is built on, which is really, of course, right, the human behavior or the instinct, the emotional response that ordinary people are going to have to price movements, right, in the charts themselves. So I just wanted to leave you with that as at Wednesday. Obviously, I only want to talk about quality as opposed to quantity at this particular time. Just be aware and be mindful that this is going to still be rather crazy. You could say there's going to be sort of a bipolar relationship in the market itself. You're going to see these big up and down movements. Overall, though, We're still in that hangover down period on the weekly time frame. Once that bases, please do not get swept up in the bullish sort of pandemonium that is going to come. I guarantee you that at some point when this market bases in the next maybe 1 to 2 months, and once we do turn the corner on that weekly time frame, and as the markets do actually bounce and again give back or make back at least 50% of this first intermediate wave sell-off, right? The actual sentiment is going to become rather buoyant. That is going to be a very dangerous situation and a very dangerous time for people who don't really understand how markets move. So this right here is a forewarning of when it does come, to maybe you should journal this down, write it down, but to check yourself. And I'll be here to talk you through it because it's going to be quite confusing for, again, most people looking at the markets and just visually seeing just what's going on if the market does stabilize and begin a rally. But that rally itself at this particular point, it's going to fail and it's going to produce a macro lower high, which is going to give people in the know a lot of opportunity to do something with it. Okay, if they've got the conviction and the courage to do so. All right, so that's going to leave us as at Wednesday, everyone. If you have any questions, email me success@pivotpoint-trading.com. And look, I'll be back with you later in the week for another market address. But just be smart out there, really. Be balanced. Again, be safe. Look after the health of yourself, your loved ones, your neighbors as well. These are really sort of testing and trying times. I understand that. But again, I'm going to walk through this in terms of obviously the markets and how this plays out indefinitely moving forward. I'm not going anywhere. You can check back in to this public YouTube resource. You can also jump into that pro analysis class whereby, again, over the weekends on Saturdays, each and every Saturday, for about 90 minutes or so, we go through and recap this in much more detail as well. Okay, so on that note, everyone, wish you a happy Wednesday evening. I'll be back with you later in the week for another market address. Farewell.